Hello and welcome. My name is Paul Hopkins and I am the Director of Acquisitions here at CPI. I'm going to dive deep into the underwriting model for Atlas A Bay Point. This is going to cover basically everything from cradle to grave, everything from the rent roll, the T12, our assumptions, exit cap, all that. So let's go ahead and get started. So this is basically the project summary here that I'll give an overview. So Atlas at Bay Point, it's a 136 unit property built in 1972. It's been recently renovated by the previous owner, but there is still a significant loss to lease. 60 units, we could add washer dryer units for additional income of $50 a unit. It's a 2-story property over 7 buildings. It includes a swimming pool, 24-hour fitness center, laundry facilities, garden, and leasing office. So the overall business plan with this is light interior value add program, improving the exterior with modern finishes, updating the paint, lighting, and replacing the roof. Property is located in a fantastic location of South St. Petersburg, just a minutes away from the Skyway Marina District, Interstate 275, 15 minutes from downtown St. Petersburg, and about 10 minutes to St. Pete Beach. This is just a project overview here, let's go ahead and dive right into it. So the first thing that I typically do is looking at the rent roll and the T12, and that kind of gives an understanding of how the property has been performing, and the current profile of the tenants, and what the current in-place rents are. So let's go ahead and look at the rent roll. So the rent roll is given to us by the listing broker. The rent roll date that I had, the last rent roll date was from March 12th, 2024. So what I did is I took that rent roll, and I basically added all the information here that you see in these columns. So the unit number, usually it says the tenant name, but I'm hiding it for privacy purposes. The square foot of each unit, what the floor plan is, and then I enter in like the beds and baths, if it's been renovated or not, what the current market rent is. And so keep in mind, the current market rent that is in this column has been determined by the current property manager. Okay, so that's what they feel that this unit can rent out for, and what the unit is actually renting for here in this column. So this is the difference between these two is known as the loss to lease, and I'll get into that later on. It also includes the date they moved in and the lease expiration. Sometimes the rent roll also includes different fees, like pet rent, utility fees, and things like that. So anyway, so what I've done is I've entered in all 136 units to come down here to a subtotal. So at 136 units, and there's the different floor plans that we have here. And so what you can see, there's a 1-1 and a 1-1 SM. So that SM stands for simply modern. It means that it's been renovated. So if you look here, 74 of these units, basically 100% of them, have been renovated, where this one has not. So this the way I separate it, then it shows me, okay, how many units have been renovated overall. But this also gives me a number of vacancies. Currently, from this rent roll, it's showing an occupancy of 94.9%, or 7 units that are currently vacant. And I get that off of the rent roll. You can see that these are the units that are vacant. It comes to a total dollar value for rent of $197,000 per month. That is the market rent. And so what is actually in place with the lease is $187,000. So there's a vacancy loss here of about $9,000 per month based on these vacant units. My analysis dives a little bit deeper. It shows, what the average in place rent is for market, and what the leases are for these units. What it's doing is it's taking an average of this actual unit, looking in this table up here, what the average is of everything that is basically a 2-bedroom, 1-bath. Continuing on, like, it also breaks down the minimum rents that these units are achieving and the maximum rents that these units are achieving. And you can see here that there's a 2-bedroom, 2-bath. The maximum rent on this one is $2,200. So that's really great, considering that our pro forma rents after renovation is around $1,805 for the 2-bedroom. And then, of course, I've got here the length of residency based on the lease expirations. So you could see, out of the 136 units, 12 tenants have been there for less than a year. 74 have been there for up to 3 years. 30 of them have been there between 3 and 5 years, and 20 between 5 and 10. So there's a lot of retention on this property, which is great, really good. And then other things that I wanted to point out here too is, let's scroll on over. So this is the lease expiration per month. So by the time we acquire the property, from the date of this rent roll, there should be about 29 leases that have expired. So we expect that, maybe 50% of the 29 leases stay, others leave, and then it gets renewed. So you can see here that, over the next couple months, we got 19, 18, 13, and then down to 5. These are the leases that expire each month. So 5, 8, 5, 5, 6, 7. This is important for later on when we look at the unit turns and renovations. Okay, so once I've entered in all the data from the rent roll, okay, what it does is it tabulates into my basically a little bit more of a summary here of the property and how it's performing. So you can see here the floor plans. If it's a 1-bedroom, 1-bath, 2-bedroom, 2-bath, what is the total number of units? How many are vacant? What's the square footage of each one of those? To come up with the average square foot of each of the units. Current in-place rents, these are what the units, each unit floor plan type is averaging per month, for each one of these floor plans to come to an average across the entire property of $1,376. Based on the current property manager's market rent expectations, they feel that they should be achieving around $1,450 a month blended across all the units. In our pro forma, we're saying that we're going to get it up to $1,551. So that's $1,350 for the 1-bedroom when they're fully renovated, $1,775 for the 2-bedroom, 1-bath, and $1,835 for the 2-bedroom, 2-bath. So this also shows the unit mix here. So we've got 56% R11s, 22% are 2-1s, and 22% are 2-2s. Okay, so the next item that I jump into then is looking at the trailing 12, also known as the T12, profit and loss statements. So this is my analysis here where I basically just take it. It's a data dump. So I dump in everything that I'm given from the broker that shows the last 12 months performance. Everything from gross potential rents to utilities to pet rent, payroll, landscaping, utilities, repairs and maintenance, turnover, marketing and promotions or advertising, administrative costs, management fees, insurance, taxes, and coming down to the net operating income. So once I dump all this data into my spreadsheet, I go through and I categorize, what does each one of these represent? So I could go through and I could say, well, this is a payroll item, right? I would select payroll, blah, blah, blah. But all these activities here are all payroll items. So I just say that, the total here, total payroll is payroll. So that way I'm not doubling up. In other cases, like I break it out a little bit more. So under utilities, I got electricity for common areas, vacant unit electricity. So I have a sub tab for that. Water, sewer, and other utilities. So I do this for basically every line item. I look at the line items and see, okay, what is the category? Is it an income? Is it an expense? What type of expense is it? And then what that does is that summarizes everything. Before I jump in too far, the date of the T12 that I was given for this analysis was January 30th. So you can see here that this goes from February of 2023 until January of 2024. So it includes the performance of January as well. Actually, the T12 is given to me basically in February, but it's ending in January. Okay, so then once I go through all and categorize everything, what happens here is I get basically annualized figures. So looking at the T12 annual figure, the gross potential rents here, I've got 2.1 million for gross potential rent. And then I separate it down even further, T6, T3, T1. T6 means the last 6 months, last 3 months, and the last month if I annualize it. And this helps us kind of determine, the overall performance and how it is performing, good or bad. And so you can see from the T12 to the T6, there's an increase in the gross potential rents. Same again with the T3. So it's showing that it's increasing. And T1, again, it's increasing even further. So that's a good sign. It's a trajectory that's going up. Other things that I do look at is, how does the vacancy look over the last 12 months? So I've got vacancy here, which is simply an equation of vacancy loss divided by gross potential rents. To come up with 1.58 for last February, 1.6, so on, all the way up to the end. I look at that for the loss to lease, the delinquencies, and any concessions offered. So you can see here, I've also annualized it for T12, T6, T3, and T1. So T12, 4% vacancy, pretty good. I had a little bit of a struggle here in the last couple of months. It did get up to, it looks like 7.8 and then back down to 6. But over the last 12 months, it's about 4%. This one here is their loss to lease. They don't really factor a loss to lease in their T12. So just wanted to make that clear. This is in their T12. They're not factoring in a loss to lease. As far as delinquencies, here's this, and then concessions is this here. So I just use this as for information for, making my analysis moving forward. So when I look at the annualized figures, I kind of go through and I look at the income that's happening, and all the expenses. And I basically kind of hand select what I feel is appropriate for using it in other analysis. But in my inputs tab, what I do is I compare the T12 and the T3 right there on my inputs tab, just to get more detailed and have that information in front of me so I could see what the history has been. Okay, so how do I use this information moving forward? So let's go ahead and now jump into basically my inputs tab. So there's a lot of information in here, and I'm sure that many people will have questions on the details or what happens if I change anything, and there's a lot can happen. So I'll do my best to kind of capture the high level of things, and if you have any more specific questions, just feel free to shoot me an email, book a call with me, and then we can kind of dive into some of those questions and what if scenarios. So on my inputs tab, basically everything that you see here in bold blue are inputs that I put in. Everything else that is in black is a calculation derived from within this spreadsheet. Before I dive into this, kind of let me give you a tour of the rest of the spreadsheet. So we already went through the rent roll, which is the information I collect, and then a summary of that rent roll and the unit mix, and then the T12. How does this, how does the performance look over the last 12 months, and dissecting it in different ways. Expense unit costs. This tab here is just more of a reference. What is the overall expected market expenses for properties across the state of Florida? You can see that the total expense per unit, in the central Gulf Coast of Florida is almost $8,000 a unit, where in northern Florida it's close to $6,200. So the expenses are a little bit less up in North Florida compared to the Gulf Central Coast. Vintage is another metric. You can see the expenses per unit for older properties, or between 1990 and 2010, or 2010 and newer. How does that all relate? Or breaking it down even further to expenses per unit count. So anything less than 100 units, 100 to 200, 200 to 300, and anything over 300. And what I do is I just kind of collect everything that kind of fits the bucket within Atlas at Bay Point. So Atlas at Bay Point is 136 units, built in 1972, and it's in the central Gulf Coast. So here's the Florida average at 8,200. For expenses, the Gulf Coast should be about 9,200. Anything between 100 and 200 units, 8,400. Built between 1889 and older, it's 7,900. And I'm going to take the average of all that, coming out to 8,400. Insurance is always the wild card, and same with taxes. So just as a kind of a quick blanket, charging $2,000 per unit for insurance, and we'll dive into that here in a second here. But this just shows you market, like what you could expect for your typical market expenses for properties that fit this category. Okay. I've got a detailed calculations tab here that shows basically a breakdown of additional income items, how I staff, in any contract services. We get into this a little bit more in depth once we're in DD, and in looking all the contract services. So this table gets updated as we go through our DT due diligence, our DD. I have a breakdown of closing costs in this tab, a breakdown of how taxes are calculated, a breakdown of all the comparable rent properties, and then my monthly pro forma, how this breaks it down into detail by month. And then I have an annual pro forma tab, which summarizes each of the 12 months to get a summary for an annual overview. I also have sensitivity analysis in here for different stress tests. I have a comparison table here, and then here's where all my waterfall calculations happen. This is how I calculate how the investors are getting paid their returns. And then a summary, limited partner returns, general partner returns. So with the limited partner returns, what happens if you invest $100,000? So this just shows a breakdown of that. And then, of course, on the back end, I have an error check. I just want to make sure that I'm checking these things, that I'm in line, that nothing is a red flag, and I go back and I verify some of these things. So, and it just helps me make sure that I'm not completely missing anything, and I look at everything. Okay, so going back to the outputs summary. I haven't gone through this. This just shows like the different performance metrics, the different return summaries, more of a breakdown of sources and uses, cash flow snapshots, our unit mixes. I also put in here our rent comps for the 1 bedroom, 2 bedroom, and all the sale comps. Some nice fancy graphs just to kind of help me visualize seeing what's going on with the property, and just to see if there's anything that kind of really just jumps out, to make sure that we're not really missing anything. So lots of information, lots of data, which is great for me. I'm data driven. Do the math, and the math will tell you what to do. So that's how I approach things, very systematically. Okay, going back to the inputs tab. So like I said, everything that you see here in blue are inputs. I've got the summary up here of the investor economics and the returns. And so here's the property, Atlas at Bay Point. Here's the address, located in South Pinellas, built in 1972. It's a Class C property based on its vintage. The total square foot is a little over 107,000 square feet. At what our purchase price is at 16.85, breaks it down to 123 a unit, or $157 per square foot. Our acquisition date, close to the end of June at 6/21. Our going in cap rate. So this is our the NOI, the in place NOI, divided by the purchase price, to get to the going in cap rate. Our market cap rate. So how do I get our market cap rate? So I use CoStar, and I got it here. So CoStar here, this is the underwriting report for this property. And if I go to submarket cap rate sell comps, so you can see here the cap rates for the markets, and where we're currently at in this market. So at the beginning of 2024, the market cap was around for Tampa multifamily at 5.5. So I look at these projections, a lot of data that's in here, and I use this as a guide. It's not setting in stone. It's not the crystal ball, but it's there to use as a guide in what CoStar, which is a massive program, costs thousands of dollars a month to own it, but they have hundreds of analysts that are looking at each market, and they look here at the villas of Flagler Point and what the market cap is in this area. So it's a great guide for us. Anyway, so I plug in the current market cap at 5.5, and who we're buying this property from, what they bought it for. They bought it for, in 2016, and what the original guidance was, which was around 22 million from CBRE. We're planning to hold this property for 6 months. Now, this is always up in the air. We just we look at a property as if we need to hold on to it for a couple of years while we do the renovation, let it stabilize over another 12-month period, and then sell it within a year. So on average, that works out to be about 5 years. We could knock it out of the park and do our renovations within 2 years and then sell it right away. That's always a possibility, but we're always observing the market and seeing how it's performing, and then make the right business decisions to return the investor's capital as quickly as possible. Basically, we're assuming an exit cap of 6. So again, we're seeing that the current market cap is up around 5.5, and we're using 10 basis points per year as an escalation to get to a terminal exit cap of 6%. Now, if I go back to looking at the cap rate, what does CoStar say? Now, again, this is just their projections and a guide, but they're saying that Tampa is currently at 5.5. It's going to come up just under 6, it looks like, and then it comes back down to 5.25, basically, at the end of 2028.
So selling this property, June of 2029 with an exit cap at 6, at least we got some cushion there. If it sells for less, well, great. Let's just keep an eye on the numbers up here. So if we did sell it for 5.25, what happens? Cash on cash stays the same. Makes sense. But the average annualized return, it jumps up to almost 27%. Okay, but that's not what we do. That's not what I do. I'm here to look at risk, and adjust based on risk, and analysis, and making sure that we're still protecting our investors' equity. Closing costs. I'm assuming an exit closing cost of 2% when we sell the property, and then adjusting exit NOI stress. So this just helps me look at if we need to stress test it for any different ways or any different reasons. And then I also have helpful resources. One big question that comes up a lot is this in a flood zone? And this is what I do as I FEMA, and I enter in the property's address into FEMA here. Into here. Get the address, do a quick copy. All right. So, so this zooming in here. So looking at this map, and where it's located, it's kind of bouncing all over the place right now. It would tell me where the boundary is for the flood area, and the based on the flood map. So that's what you use to see if this property is in the flood zone or not. Okay, so more of a breakdown. So syndication and structure fees. So we're putting an asset management fee. An acquisition fee of 2%, which is 2% of the purchase price, for a total of $337. Asset management fee of 3% of the effective gross income. That totals around $407,000 for the life of the project, over the 5 years. Equity contribution. This is calculating that we're going to need $10.5 million in equity. Now, in my analysis, it shows that 0% is actually coming from the GP. That is not true. The GP is actually putting down 10%. However, the way that my model is structured, that if I put 10% here, it gives it different metrics and different performance. And I'll just show you, for example, taking that to 90%. Now that shows that we're coming in with 10%, so just over $1 million. And that increased the average annualized return. So the reason I don't do that is because our equity is being treated as the common equity, as the limited partner. It's not getting any special treatment or anything else. So we're treating as the same. So in reality, it is 100%, and getting the same returns. But when I do it in my spreadsheet, when I factor that in, it just changes the metrics a little bit, and it goes down a different path. So when you look at my analysis, keep that in mind. We are contributing 10%, which is just over $1 million into the equity. We've got an 8% preferred rate of return. We're splitting it 75-25 with the promote. And this is how I could come up with a fancy waterfall, change the preferred rate of return, change it from 80-20, 90-10, 50-50, whatever you want. And that's where I change it here. I do not use this in this model. This is, if I was to, look at co-GPs and bringing in preferred equity or giving them preferred return, we're not structuring it that way on this deal. So I don't use this part of my model for this property. Okay, so we already went through the rent roll and the unit mix summary. All that information is basically repopulated here. So a total of 136 units, average square foot 787, average in-place rents is 1376. That's the average of all these properties, which is the average of all the floor plans, what the current market is at 1449, and our pro forma rents of 1551. Which and it shows us which ones we're renovating. We're actually going to be renovating basically all the units, or at least in this model, we're showing that we're renovating all of the units for 136. So the rent premiums that you see here, the one bedrooms, it's a rent premium of $100 to $124. Not a whole lot. But the rent premiums that you see here for the two bedrooms, it's a big jump. And so why is that? The reason being is because we are including the washer dryer units into these rents. So it's an extra $50 that's baked in there. And the reason that we did that is when we looked at the comparables to make sure that we were comparing apples to apples, they also had washer dryers in their units. Okay. So 1551 is our average pro forma. So if we look at the one bedrooms, 1350. Well, let's look at the rent comps for a second. Well, I got the more of a breakdown here. So this is Atlas at Bay Point right here, and then these are the different properties that we looked at. And where they're located, address, C class or B class, and then a breakdown of the summaries here from high to low. So you can see here some of the details if you want to dive into it, and the summary breakdown here. But I got it represented better on this tab here. So scroll on down. So looking at the one bedrooms, Alice at Bay Point in place rent $1,250. So you could prove that right here. This is about $1,250 for the in place rents. Per forma of $1,350, and the average of all the properties is $1,332. You can see that these properties up here, it has an average of $1,472. So we're still, about $100 less than the average of the highest properties. So, it's still got a bit of room to move. Then looking at the two bedrooms, 1775 and 1835. Again, looking at the two bedroom comps, the in place average of the two different unit mixes there, the 2 1s and the 2 2s, for an average of 1535. Our pro forma is 1805, and you can see the units here that have 1950 and 1875 and 1795. So in this, keep in mind, again, this is including the washer dryers. So that's our pro forma rents. Okay. And then we're going to go down to talk about timing. When are we starting the renovations? So we're going to start the renovations in month 2. And the duration of the renovation, now this is a very light value add, very light, and we're going to get into basically the CapEx budget for each of these items. But since it is so light, it's going to be super quick to turn that over and then to remarket it. This property is currently today at 99% occupied. So with one unit down. So that just shows you that the demand is there, and that the rents are low. So, but we're assuming that the renovation and the remarketing is going to just take 1 month, since it is a light renovation. The average monthly velocity of how many units we're turning over each month, we're doing 3 units a month. And if you go back to basically the rent roll, as what we were discussing before, and how many leases are expiring each month, I'm going on the very low end. I'm assuming that 50% of the slow period, so about 3 units a month, except for this month, we're going to be able to turn those units over. We might be able to do it a lot quicker, going up to about 10 units in some months. But three units a month, that comes out to 45 months of basically turnover. So very slow. We're taking our time. so we could definitely accelerate that, and that would actually boost up our investor cash on cash. So that is our business plan. But the way I underwrote it was to be conservative, as if like, what is the base case, what is most likely to happen, what is least likely to happen, and then kind of being kind of conservative in a way. So I feel like I am conservative here, but I just wanted to highlight that. The rest of this stuff is just kind of like our project timelines. Okay. And now I get into basically a breakdown of the interior CapEx and exterior CapEx. So just to summarize, interior renovations, $525,000. That comes out to about $3,800 a unit. And it calculates basically the ROI, the return on investment for that renovation, for getting that rent bump premium. So 54% ROI, hey, that's pretty good ROI based on that. Exterior renovations, 1.1 million, 8,400 a unit, 25% ROI that we're achieving on that. So total all in renovated costs of 12,000 a unit, or 1.6 million in CapEx. All right, let's break that down a little bit further. We've got 10% contingency baked into all these total costs here. So looking at the one bedroom units, ceiling fans, LED lights, backsplash in the kitchen, bifold doors, new bedroom doors, and hardware. So the average that we're spending here is $1,325, applied over the 38 units, one bedroom units, and then adding in the 10% contingency on top of that. For the two bedrooms, similar thing, where ceiling fans, LED lights, backsplash, new doors, and hardware. And that's an average of $2,000 a unit. We're also adding washer dryer connections to all the two bedroom units. So it's $1,650 a unit times 600, but we're baking in $100,000 for that. And then we also have an HVAC contingency. We're glad that we have this because as we did our due diligence walk, we did take note of the age of all the hot water heaters and the AC units and condensers, and about half of them are at its near life, and so we set aside enough to take care of that. Okay, so then as far as the exterior CapEx and what we're doing, we got pool upgrades and furniture. It's basically what we're doing. The pool is recently resurfaced. And so we feel that new furniture could really bring the property to life. $100,000 for siding and facade and painting the exterior. $140,000 set aside for landscaping, really improving the landscaping. When you walk into that property, it feels great. It's beautiful. But that's just when you walk to the leasing office. Everything else could use a little bit of a TLC. And then $640,000 for the roof replacement. So that is a hard quote that we got. We had 15 roofers go out to the property. We're gathering all the quotes in now, but 640 was one of the best quotes that we got from a reliable roofer. Okay, signage and rebranding. We're rebranding the property. We're buying brand new signs at the entrances and making that pop. We got exterior lighting. We're adding in some new exterior lighting features to the property. And let me just show you. If you missed our webinar and missed our presentation, I'm going to show you a rendering of what we are planning to do on the exterior. One second. Here we go. Okay, so this is the current exterior. And like I said, exterior paint, landscaping improvements, monument signs, additional exterior lighting. And the roof replacement, knee wall, mansard roof replacement. So we're going to be replacing this shingles or the mansard roof with something a little bit more modern, like this that you see here. And adding in some pool furniture and optimizing laundry units. But you can see the difference between these two properties, how this one looks a lot more modern, new paint schemes, lighting on the outside, new door numbers, really making it pop. And that's the same here, like either lighting up here or in the flower beds, pointing up, painting these walls, making them accent, pop out, and new doors and lighting in the hallways. Sorry, new door numbers in the hallways. So this is this is a rendering of a nearby property. Um, as far as the interiors, this is the current interior and how it looks. Great shape. We walked all 136 units a week and a half ago, and they look just like this. Same with the bathroom. But adding in ceiling fans, backsplash, blah blah blah, new doors and hardware, electrical plumbing features as needed. Okay, so got that set aside. So that kind of gives you an idea of what we're doing for the exterior and interior capex. Okay, our debt. This is always a big topic, especially with what's been going on over the last year, and all the bridge loans that these other syndicators had got and currently in hot water. Well, we're going with low leverage, minimizing the absolute risk on this property, being risk averse, just so that we can maintain cash flow. While the market still tries to stabilize. So we got different quotes in: 5-year fixed at 55% LTV, 7-year fixed 55%, 5-year fixed with a max LTV, or 7-year fixed with an LTV, max LTV. But what I want to point out here is the reason that we chose with a 55% 5-year fixed is because the spread of 1.5 was better than max LTV. So you can see the difference here in the all-in interest rates. This is based off the 10-year Treasury, which we all know that has been going up and down over the last couple weeks. So, this is subject to change. We are receiving our quotes from Fannie and Freddie hopefully tomorrow, the updated quotes from our underwriting. And they're giving really good terms, meaning that they're giving us a low spread, interest only for the full term of 5 years. Whereas if we went with a max LTV, they could only give us up to basically 24 months of interest only, which would impact your cash flow. And then the minimum DSCR of 1.55 versus 1.25. So what I used in the underwriting, and you can see they quoted at 9.35. So we went with 55%, which is coming out in this model at 9.26, 9.26%, and I'm using 6% all in instead of the 5.81. Yep, 6%. Full term IO, 30-year AM. It's coming with a 1% financing fee that's built into it, and so at the end of the day, our DSCR is at 2.03, so well above the 1.55 threshold. We're not factoring in any refinance. The reason I don't normally do that is because it's kind of like a false sense of security. We could show it, and we could show that you're getting your investor returns, principal paid back earlier, which is one way to do it. And I don't do it because there's just too much unknowns and too many factors that could play in the market in the next 5 years. We want to try to minimize the number of variables that I'm adding into this to show those projected returns. So if I was to show that we are going to refinance this property in 2 years, it would probably boost up the returns. So keep that in mind. If the opportunity presents itself, sure, we'll do it. But in my underwriting, I don't typically show it just to keep a conservative basis. No supplemental at this time, but again, in 5 years, the question comes up: what are you going to do in 5 years? You're going to sell it? You're going to refinance it? You're going to whatever? Yeah, we could do all the above, or we could refinance it, or buy a supplemental, or get a supplemental to add on top of that. So there's lots of options that we could look at when the time comes. Pref equity, we're not structuring any pref equity into this deal, and so that's where this box would come in handy if we wanted to look at that. All right, so this is showing the sources and uses. 9.2 million of debt from agency, Fannie or Freddie. And 10.5 million in equity, coming for a total purchase price, or total all-in price, sorry, of 19.7. Let's break that down a little bit further. So purchase is 16.85. We got a financing fee, which I showed up there. Closing costs of $421,000. That's about 2% of the 2.5% of the purchase price. Where did I? So I had that up here. Yep, 2%. 2% closing costs. So that's where I would change that. And then other closing costs right here. 2.5% for the acquisition closing costs. This was the sale closing cost of 585. So 2% on the sale, and we're assuming 2.5% at purchase. So it comes out to 421. As we go further into our due diligence and getting all these quotes solidified, we'll update these numbers and making sure that we're going to stay underneath that 2.5%. So go back down to our capital stack. So 421, that's the number you saw back there. Our acquisition fee, interior capex 525, exterior of 1.1, and a total of 4 months of operating expenditures as our reserves. So you could set this to zero and assume that you're going to have perfect cash flow, but sometimes there is a rainy day that you need to have a little bit extra cash on hand. So we are raising an additional $400,000 for our reserves, and that comes out to 19.7. Okay, now we're getting into our growth assumptions. Okay, so you can see here a breakdown of all our assumptions, what the T12 is showing and what the T3 is showing. So the total economic loss on the T12 is 5.2. On the T3, it's 8. The reason that it's had a bit of a economic loss of 8 is because you can see the physical vacancy jumped up from 4 to 6. And they offered, and they had a bit of a collection loss. Reason being is because this property has been handed over, or gone through 2 purchase agreements where the staff has actually turned over during this time, thinking that they're going to lose their job or something's going on. So they've had a lot of staff turnover. And mismanagement and high operating expenses, which you'll see here in my underwriting. The more we dug into it, we realized, what was the story, what was going on, and how we're going to fix it moving forward. So we're showing a total economic loss of 7.2. But what this is not also considering is our vacancy loss from renovations. So in my output summary here, right here, physical vacancy and renovation vacancy. So year 1, 6.7 physical vacancy, and 2 for renovation vacancy, and that's 2, 2.1, 2, 1.7, and then 0. So renovations basically taper off between year 3 and 4. So for a total economic loss of 9.9 and 10.3, compared to the T12, it shows 3.7. So there's a missing item in there. So anyways, so we have physical vacancy of 6. We're assuming a 6% vacancy while we're doing the renovations, and then tapering it down to 5, which is our basically our market vacancy for this location. Concessions, you can see here, non-revenue units. We're not planning to set aside any model units or units for staff, so we're leaving that at 0, and then the collection loss of 0.5%. Organic rent growth, 1.5% in the first year, and then 3% thereafter. Okay, so now organic rent growth is always a lever that you can pull to really boost returns or bring it back down. And we have to be pretty realistic when it comes to this assumption. So, how did we get to 1.5 and 3? Well, if we look back at CoStar here and looking at, there's the submarket. I want to look at this submarket report. Yeah, so rent right here. Okay, so this is the South Pinellas submarket report. So this just shows the rent and the forecast for what's going on in South Pinellas. So you can see it breaks it down by quarter, and so it's kind of in my table or in my analysis it does it by year. So I'd have to take the average of all these, or what we could also do is get from CoStar an actual output of the asking or the rent projections for South Pinellas annually instead of quarterly. So you can see here it's basically about 2%, and for 2024 jumps up to about 3.5, 4%. 2025 and tapering back down to 3.5 thereafter. So we're staying below these assumptions, and that's how I kind of I got to these rent growth assumptions. Other income staying at 2% year over year. Expenses, the first year I keep it at 0 is because we're fine tuning the expenses. We're bringing the expenses back down. Don't expect to have any growth because we're nailing that number in tight for the first year. And so 2.5% basically across the board here for expenses, repairs and maintenance, payroll and insurance, and real estate taxes. So insurance and real estate taxes are always the variable in underwriting, especially over the last couple of years with insurance costs and how they went really crazy. Well, we have seen the light at the end of the tunnel, and we're approaching that. And again, it's not my crystal ball, but it's at least my projection and what's happening here. So we have secured really good insurance for this property. It's because we're putting it on our property manager's master policy program. AmRisk, which was a carrier that was very competitive in the market, had left the market a couple of years ago, or a year and a bit ago. And what that did is that drove insurance costs up because it became a monopoly. Well, AmRisk recently came back into the market and made it competitive again, and you have seen rates drop pretty dramatically. And it sounds like they're there to stay now. And they've got very strict criteria. This property fits within their criteria, and we've got great guidance from our insurance provider on what they feel the insurance is going to be. Real estate taxes too. It goes up and down often. It's really hard to judge what's happening with taxes, but we have hired a tax consultant that's basically going to help us on performing the taxes. And right now we're just keeping it at 5%. The max that they can do, the max they can reassess your property at, is a 10% increase, but it averages about 5%. Okay. And then I'm looking at inflation assumptions that are on an annual basis. Okay, and now hopefully you're still with me here and how I'm digging into all this. So now we're getting into the pro forma. So right here I have the T12, the T3, and our year one projections. So you can see here the gross potential rent 2.1 for T12, 2.23, and we're getting it to 2.3. You can see here that we're going from 2.1, 2.23 to 2.27, but we're renovating units, so we're getting a renovation premium on top of that to get to 2.3 for an average rent of $14.14 at the end of year one. So physical vacancy, we're factoring in the 6% that was up above. We got renovation vacancy of 2%, so on and so forth, down to a 9.95, and showing a 3.72 total economic loss for T12 and 6.5 for T3. Okay, other income. So it got a little messy in their T12, and what they were charging fees on, and so on. So we broke it down a little bit further in our detailed calculations tab here. Looked at what we could be getting for late charges, application fees, valet trash. This is our net profit on valet trash. There is an expense, and then there's an income. This is just the net profit. So that's what I'm factoring in here. Same with the bulk internet. This is our net profit. We're switching it from basically like a RUBS feature. They had utility fees and a RUBS feature for their water and sewer. And we're taking that and converting it into a flat fee for the 1 bedrooms and the 2 bedrooms of $60 and $80 respectively. Pet rent of $20 a month, only applied to basically 10% of the units. Pest control, washer dryer, that's included in the 2-bedroom units, and then laundry at $35 profit per unit annually. And then what I'm doing is I'm ramping up the utility fee. So you can see here at 8.3, 16.2. So it's ramping all the way up to get to 100% across the units as leases turn over, right? So this is on a ramp up for the fees. So I broke that down here, and so you can see the total amounts here. And I tried to line it up as best as I could. So valet trash at 350, we're getting it up to 379. Bulk internet is the property recently introduced bulk internet, and so over the last 12 months they've been wrapping this up as lease turn over. And so you can see here it went from 414 to 613. We're carrying basically 613 moving forward. The flat fee utilities right here. Pet rent normally 77 a unit. We're taking it down to 24. Pest control is a line item that was kind of baked in here into their miscellaneous and fee income. And then laundry. So since we are adding washer dryer units to all the 2-bedroom units, we are going to be taking away basically revenue into the laundry facilities, and so we're taking it by half, almost half here. So it's 76 to 36, and dropping that income down. So you can see the total income is about $2,300 a unit, and we dropped it down to $2,000 a unit. But then that wraps back up as we reintroduce the utility fees, and it gets it grows on basically the back end. Okay, so then we're looking at our operating expenses. So I have it broken down between the controllable and uncontrollable. What can we control? We can control payroll. We can control what we spend on lease turnover, and landscaping. What we can't control or uncontrollable costs are basically the utilities, property management fee, insurance, and real estate taxes. So that's the two that are separated here. So repairs and maintenance, we're taking it from 401 to 425. Contract services 364 to 445, and keep on going down the line here. So total repairs and maintenance, payroll, blah blah blah. You see the full breakdown of each. General administrative, and why there's such a drop between general administrative from T12 to now is, like I was saying earlier, the administrative staff, there was a lot of turnover. There was a lot of extra costs for training and staffing and things like that. So it got a little out of control. and bringing this back down to market. So when you look at the numbers here as far as the expenses per unit and comparing to the property, we're also looking at our property manager has other properties within this market, and they know exactly what they've been spending on average across their entire portfolio. And we took those numbers and plugged them in here, in knowing that's what we can achieve on this property. So that we see opportunities here to improve these expenses. Same with some of the utilities. Some of the utilities, there was some issues with the electricity. So this is also based on the vacancy units that we're working on to reduce that cost down. Water and sewer, we're pretty much keeping the same. And then other utilities. Other utilities that included bulk internet expenses, and the valet trash, which I took out of that equation, and I was more looking at the spread of what we could get for a profit up here. And so this was, I think, just bad accounting on their behalf of what they were doing. But there's half a dozen of one and 6 to the other. So I was trying to get that phrase right. But yeah, you could do it either way, but it's just I cleaned it up the way that I like to see it. Property management fee at 3%, insurance, and so if you look at their insurance costs, they're way high for what this property should be paying. We have a solid quote in hand for $1,200 to $1,400 a unit. We're using $1,500 a unit. After 6 months, we're using $2,150 for that matter, for the first 6 months. So you could actually, if you want to dive into my underwriting, you could see that here. Insurance costs of $2,150 for the first 6 months, and then it drops down to $1,500. Excuse me. Okay. Coming out to a total expenses of the T12 is at $10,500 per unit, and an expense ratio of 59%, or $11,000 per unit, or 65% operating expense ratio. This is very high. And if you remember, our expense costs here for what we should expect to see this property somewhere between $8,000 and say $9,500. We're still still about $9,000. Yeah, this is where we should be at with this property, and an operating expense ratio of around 45 to 50%. We're still above that 50% ratio. So their expenses are very high for this property. So we're bringing that back down. Okay. Taxes. So let's talk about this for real quick. I'm using the assessment percentage of 80%. So, when a property is purchased, the tax assessor will look at the sales record, and they'll take 80% of that, anywhere between 70% and 80% of the purchase price to get the assessed property value. Apply all the ad valorem charges, or known as the mill rate, and getting to a total annual price of $267,000. So when you look at the real estate taxes, we're bumping it up just a little bit slight than what they're currently paying, from $217,000 to $267,000. Now, talking with our real estate attorney that is going to be consulting us on this property, and they have a strategy that they use, which has been quite successful, and it's legal. It's legal in the state of Florida. It's legal with the IRS. It's legal with the SEC. But what they do is they basically separate the value of the property, they break it down into tangible and intangible assets. And then what is recorded is the tangible value of the property, and that's what gets assessed. And so they have given us a projection of what the taxable value is going to be year over year. So 222, 237, 254, 272. I could turn this on within my model and use these actual tax rates. So let's look what I actually used in my annual pro forma. So year one is 222. Go to my pro forma, go to real estate taxes, and I'm using 267, 281, 295, 222, 237, 254. So there's a big savings that's there. They were projecting about a $60,000 savings to typically what would be the price difference without using their strategy. So just as a just for information, keep an eye on here. So 21% average annualized return. If we were to use their projections, which have been quite successful, and I'm going to turn that on at 22.1. So it increases your average annualized return by using their taxes. But again, I'm taking the conservative approach. I'm saying, it may or may not happen. Let's not bank on the fact that that our taxes are going to be reduced. So, yeah, that was a little over an hour long. So I apologize that it went this long. But there's a lot of detail that goes into underwriting and analyzing these properties. Lots of consultation with the property management company, with our tax attorneys, collecting insurance numbers, collecting debt guidance, and understanding that we're using the appropriate fees, and closing costs, all that stuff, and that all adds into our underwriting. So hopefully that was helpful for you. Again, feel free to reach out to me if you have any questions whatsoever on the details. Before I get off here, the sensitivity tables, there's a lot of data in here, but what I wanted to at least highlight here is, what is the limited partner return? And I've got it separated here for IRR, average annualized return, cash on cash, and equity multiple. That's what each one of these numbers represent based on the title. So holding period of 60 months, which is 5 years, at an exit cap, these are our return metrics. If we hold it for 36 months or 84 months, what is the difference? Cash on cash drops a little bit, but the average annualized return drops a little bit. Holding it for 84 months, cash on cash increases, our equity multiple increases, but not so much difference with the average annualized return. So you could see, the different stress tests that we do, and like what if scenarios, because we don't have a crystal ball. We're using the best assumptions that we have from the best information that we have, using the experience from ourselves, from our property manager, from the advisors that we all have, in the mastermind groups that we belong to. What's going on in the market, constant changes that are happening all the time. So we're staying on top of this, giving it our best shot, but understanding that the market can shift, and so we need to be kind of protecting our overall returns, our money, your money, and we're using some conservative assumptions. There are definitely some ways that I can make it very aggressive in this underwriting model to show you great returns, and we could play with that if you really wanted to. But what we need to do is set basically a line in the sand saying this is our base case scenario, and using our conservative underwriting and analysis. So hopefully that was helpful in education. educational for you, and happy to dive into it a little bit deeper with you if you have any more questions. So thank you, and see you soon.